therefore, my strategy is instead of going over that topic again, actually I want to teach you related topic in finance, which is value and risk. And by learning this topic, I want to teach you indirectly about the significance interval and hypothesis testing. Okay? Value at risk is very important topic in finance. And then value at risk is, could you please raise your hand if you have ever learned about value at risk? No one? Beg your pardon? In the graduate class, right? Okay. So besides the two graduate students, so no one knows about value and risk, right? No. Okay, anyway, it is very simple topic. Even it is so simple that I think even high school students can understand it very easily. So value at risk. So basically, value at risk is a concept to answer this important question. What loss level is such that we are X% confident that it will not exceed in n business day? Okay. Again, value at risk is answer to this question, basically X. Okay. And what loss level? Actually, it is loss level, so it is amount. So it is what it is answer to this question. So what loss level is such that we are X% confident that it will not exceed in n business day. So value at risk is basically whenever we say value at risk, basically we have to need another two values, these two. I think the example it is more clear if we look at the example. But first, actually value at risk is there are better concepts than value at risk, which is called expected shortfall. Okay? So value at risk is the loss level that will not be exceeded with a specific probability. Okay? It is level of loss, but expected shortfall is more intuitive. It is called also C bar. C bar is the expected loss. Okay? It is not level, it is amount, expected loss, given that the loss is greater than value at risk level. So it is like expectation, conditional expectation. Conditional expectation such that what is conditional expectation? Conditional on our loss is greater than certain level, and that certain level is called value at risk. Anyway, although expected shortfall is theoretically and more appealing and more intuitive, but it is value at risk that is used by regulators and practitioners in setting bank capital requirements. So, for example, every bank should have a certain amount of capital 자기자본, and that required amount of capital is determined by the value at risk of the company, like 3 times of value at risk, something like that. So what is the advantage of value at risk? It captures an important aspect of risk in a single number, and it is easy to understand, and it asks the simple question, how bad can things get? So there are many ways, but first, historical simulation to calculate one-day value at risk. It's like creating a database of the daily movement in all market variables, and the first simulation trial assumes that the percentage change in all market variables are as on the first day, and second simulation trial assumes that the percentage change in all market variables are as on the second day, and so on. We will examine the example of this case shortly. Again, the historical simulation on Thursday 11th September 2010, what happened is a massive sell-off of stock occurred. Suddenly, there arrived massive sell orders. The day was happened to be also the expiration date of the many option contracts. And then the huge selling started about 14:50 Korean time, which is just 10 minutes before the closing of the market. And then a group of unidentified foreign investors unloaded 1.6 trillion won, which is around 1.4 billion, of the stock through Deutsche Bank Group's Korean Securities Unit, and causing a benchmark Kospi to drop 53.12 points, almost 3%, to 1914.73. So within just 10 minutes, Any question? What is your question? 네, 그런 거 나중에 집에 가서 구글 검색을 하면 될 것 같습니다. 네, 어쨌든, 네. 그래서 just 10 minutes, like 3%. Stock index dropped 3%. This, in nominal value, this wiped out like 30 trillion Korean won, which is approximately 27 billion USD in just 10 minutes. The size of the dumping sell-off accounted for like 1/3 of the total daily trading. Okay? From 9 to 3, we can count the total daily trading, and then within 10 minutes, 1/3 of the total trading happened that day. The rest of the market participants could not respond to the large order properly, okay? Because Deutsche Securities Korea made the order in the last 10 minutes, and now the system changed just because of this event. Like 3 years ago, okay, before market close, like 10 minutes ago, it was auction timing. So at the time during which all transactions were processed together at the final auction while ordinary trading was suspended. So at that time, the market closes at 3 o'clock, and then when we receive order between 2:50 and 3 o'clock, we don't press the order at the 10 minutes. We collect all the order together, and we settle the all order together at 3 o'clock. Actually 3:05 something like that, but approximately 3 o'clock. We process that all order together in the last minute. Therefore, it was the previous system. Therefore, since this massive sell order occurs at the last 10 minutes, therefore, other market participants could not properly respond to this massive sell order. So stock price dropped. Stock index dropped like 3% in 10 minutes. Therefore, it is no wonder that regulatory agencies immediately suspected that, okay, there must be something going on. Okay, something going on over there. Okay, they suspected that foreign hedge funds has bombarded the market with sell orders. Speculative hands purchased the option contract right before the expiration date, and then unloaded their stock holdings to trigger the tumble of share price and make huge profit. More specifically, those investors must be holding option contracts that yield profit when stock price drop, hit the jackpot during the process. Okay. So more specifically, put option, right? Put option, if you have a put option, and if stock prices drop, then you make money, right? So suppose you have power to control the market price, and if you have put option, then you want to make stock price drop, right? In order to make money. actually that is possible if you have a huge order, if you can send huge order. So you have put option, and just before option expiration date, okay, you send massive sell order, and stock price go down, and you make a lot of money. You put option. 네? 어차피 옵션 expiration date 하니까 그건 상관없는 거지. 네? At the expiration date, there is no difference between American and European option. It doesn't matter. Actually, at the time, the put option was usually at the time because such option contract had become very cheap at the almost useless to buy because as the expiration approaches and as the cost seemed to have taken an upturn, therefore put option is usually seemingly useless. Anyway, figure 1 and table 1 illustrate how serious the option shop was. Where is, let me open this window, another window. Okay, this is figure 1. So it was stock market was okay, and suddenly to the big drop, right? And then new record created on November 11th, 2010, unit $1 billion. New record. So net selling by foreigners, 13,099 is a new record. Previous record was this one. And the net program selling, new record. And net program arbitrage selling, again, like this. And KOSPI 200 trading volume was greater than before. So in any measure, it was a very massive order, and it was a very significant event in the stock market. By the way, 박남주 학생. The media at the time, newspapers and TV called this mini crash as the 11/11 option shock. Some even call the event as 11/11 option terror or option terrorism. And then one brokerage firm surveyed its employees and they find that 11/11 option shock as the most salient events of the year 2000. Okay. And then in this, okay, this is also a brief description about 11/11 option shock, and there are some major players involved in the event. First, it has been rumored in Yeouido that many financial institutions made great losses and had been collaborating in order to hide those losses. Nevertheless, three players stood up. The most significant player was actually Wise Asset Management. Wise Asset Management had traded option contract and had made a profit for a while before this event, but suffered large losses before the market closing because of the option shock. So this firm was okay, but suddenly they made a huge loss at the option shock. Its loss mostly resulted from short position in strangle. Okay, I'll explain what is strangle shortly. The buyers of the strangle, sorry, I need a period here. Yes, strangle. The buyers of the put option contract asked YJS to sell at 499,000 won per contract, which is 10,000, 100,000 multiplied by closing price and strike price of KOSPI 200. And here, 100,000 denotes the contract size. And then because of this one, the liability rose to 89.9 billion Korean won. And then the YG Asset Management had broken the investing basically 73 times of their capital. Their capital is only 10 billion Korean won. Okay, and actually it is 7,300 times of their capital. And in regulation, only firms can invest 5 times of the capital. Okay? So that's 73 times of their capital, which is much more than 500 specified by the law. Consequently, YGSZ was unable to pay out the liability. They sold the contract because, and then they have to pay money. But problem is that they couldn't. They didn't have enough capital. Their loss is 73 times of their capital, so it is impossible to honor the contract. Consequently, YGS was unable to pay out the liability. Instead, Hana Daetu Securities, which sold options on behalf of the YGS management. Okay, so Hana Daetu Security was brokerage. They were providing brokerage service to YGS management. So as a broker, actually they paid 76.3 billion Korean won to the investors, and then they have to receive money from now YGS management, but YGS management cannot give money to Hana Daetu. Okay. And of course, bad luck continued, which always happen. Okay. Bad things tend to happen together. The information about the massive loss had quickly spread throughout the market and triggered a fund run. Fund run is similar to bank run. Bank run is people run to bank to withdraw their money. Fund run is people run to fund to withdraw their money from each fund. National Pension Service, 국민연금, and other investors in the various funds of the YGS management ran to withdraw hundreds of billions of won from the fund. On November 26, an employee embezzled 3.8 billion won. This series of events around the option shop severely damaged the reputation of the YG asset, which is critical to asset management business. In response, YG asset sued OCW-HYU Securities Korea about the option shop. Another player, Hana Daetu Securities. Hana Daetu Securities, which is a Korean brokerage firm, they lost 76 billion Korean won again. They shouldered this amount on behalf of the YGS management, which turned out to be insolvent. YGS management also declined. Actually, they also declined. They didn't have ability, and then they also declined paying Hana Daetu, arguing that the mutual fund, the YGS management, was not obligated to compensate the loss of Hana Daetu Securities. The Hana Daetu conducted a due diligence. They actually inspected the YGS management for the payment and the possible acquisition, and it also sued major shareholders of YGS management and brought lawsuit against OCW-HYU Securities Korea on February 26, 2011, 서울지방법원, okay, Seoul Central Court. And then the KRX issued a warning to Hana Daetu about the failure of the risk management and the rate margin deposit on the derivative trade by YG Asset Management, and Hana Daetu had been required to receive 80 billion Korean won by one day before the event, but they didn't. Thus, if Hana Daetu had received the deposit as required, it would have much less problem at the option shop. But clearly, that 80 billion Korean won is again like more than 70 times of the capital of the YGS management. So anyway, that was impossible. Last player, which is the series of trading orders, 7 to 8 of trading orders from Deutsche Bank Securities made most of the 1.6 trillion Korean won, 1.4 billion USD sell off at the option day, option shop. In addition to the trading, that was suspected manipulative, Deutsche Securities breaches KRX rule, 증권거래소 규정, which requires disclosing computer-driven trade by filing a report 1 minute late to the KRX. Okay, so it is kind of minor. Okay, it is minor, but anyway, Korean regulators estimated that Deutsche Securities made 45 billion Korean won of unfair profit with the trading and suspected manipulation and the inside trading, such as buying put option. Okay, so it is exactly what I saw. Actually, maybe the better strategy is that if you can send a large sell order, and if you know people cannot properly respond, what you can do is first buy put option at a very cheap price, and suddenly send a massive order, stock price go down, and you exercise enough put option and make a long one. Clearly, it is illegal, but anyway. It is insider trading, such as buying put option before sending massive selling order. So that's what Korean regulators suspected. Now let's investigate this event further. Derivative positions of YGSM management. Do you have any question about now? Do you understand this event? Yes. 그런 일이, 그러니까 911 때도 알지 못하는 선물 매도 포지션이 대량으로 거래가 됐었다는 그런 일이 있었죠. 어쨌는지 모르겠지만 경보가 있었던 거지, 911. 풋옵션보다도 더 확실한 방법은 쇼 포지션을 취하는 거지. 그래서 911 때 실제로 그런 일이 있었다고 합니다. 그리고 여러분 믿거나 말거나 우리 연평도 포격 때 그때 주가 좀 떨어졌죠. 근데 연평도 포격 직전에 풋옵션과 숏 포지션이 많이 거래가 됐다고 합니다. 그러고 나서 북한이 하진 않았겠지만, 그러니까 금융 전문가들은 감이 있었던 거지. 뭔가 일어날 것 같다. 그리고 제가 요즘 그 박사과정에 파키스탄에서 박사과정 파임이라고 박사과정 학생 하나랑 쓰고 있는 논문인데, 파키스탄에서도 그 테러리스트 이벤트가 어택이 일어나기 직전에 스탁 프라이스가 떨어지는 경우가 되게 많이 있었어요. 어쨌든 그런 거에 대한 금융시장이 뭔가 정보가 있는 거지. 왜 그런 정보가 있는지는 잘 모르겠어요. 그렇죠. 이런 거 아예 그런 걸 노리고 그런 걸 트레이딩 했는지, 아니면 금융시장이 뭘 알기 때문에 어쩐지 모르겠지만, 어쨌든 금융시장은 여러분이 아는 것도 훨씬 예지력이 있다. 증권 찌라시를 통해서 그런 것들이 많이 돌아다니는 그런 것들이. 근데 또 진짜 고급 정보는 또 증권 찌라시로 안 돌아다닌다는 말들이 있어요. 그래서 증권 찌라시 모델은 사실이잖아. 연예인 이런 거. 증권 찌라시 통해서 돌아다니는 연예인 스캔들 보면 다 사실이잖아. 어쨌든, 네. 그래서 금융시장의 그런 정보력을 무시하면 안 됩니다. 어쨌든, derivative positions of wide asset management. So, apparently, wide asset management was the biggest victim of the option shock. It sold strangle short strength position with 200 index underlying asset. Okay, again, yes. So their position was short strangle position, and its underlying asset was KOSPI 200. I'll explain to you what is strangle. In a short strangle, which was the position of the wide asset management, an investor sells a put and call with the same expiration date but with a different exercise price. Okay. suppose this exercise price. Okay. What is the call option payoff at the maturity? At the maturity, call option payoff looks like this, right? So it is exercise price. So therefore, if stock price is greater than X1, they will exercise call option and make money by this amount. If stock price is less than X1, then they then exercise call option and make no profit. So basically, as you know, call option is a contract. It is a right to buy an asset at the exercise price. So therefore, if asset price is greater than X1, you can buy some valuable asset at a lower price. So therefore, you will exercise this right, and you get the profit. Okay, but it is also right. Therefore, if stock price is there less than the exercise price, you don't have no reason to buy cheap asset at the higher price, right? So you don't exercise the option. Therefore, pair looks like this. And how about put option? Put option is right to buy, no, not buy, right to sell an asset at a specific price. If an asset the price is higher than X2, it is expensive asset. So you have no reason to sell expensive asset at a low price. So you don't want to exercise the put option. If asset price is lower than X2, okay, then you can make money because now you can sell a cheap asset at a higher price, so you make money. Okay, so it's a call option and put option. Now, okay, in a short strangle, okay, we have a long strangle and short strangle. Long strangle is opposite of short strangle. In the short strangle, an investor sells a put and call together. Okay, so it is a long position of the call. Then what would be the short position of the call? Short position of the call would be looks like this, right? It is short position. So it is what happens if you have call option. This is what you will have if you sell call option. 아, 맞다. 아, 죄송합니다. 네. 그렇죠? 이렇게 되겠죠? 이렇게 되고, 네, X1. 그렇죠? So if asset price is greater than X1, the option holder will exercise asset. They will ask you to hand over an asset which is expensive at a low price at X1. Therefore, you have to sell an asset which is valuable, expensive at low price, so you will make a loss like this amount. Okay? If you have a short position in the put option, then you will have something like this. If again, if asset price is greater than X1, put option holder doesn't exercise the option right, therefore nothing happens. But if, okay, if an asset price is lower than X2, now put option one holder sell cheap asset at a higher price, and then therefore you have to accept that order. You have obligation to honor the contract. Therefore, you have to buy cheap asset at higher price of X1. So this is a short position of the call option. This is a short position. Okay. Okay. Short position of the put option. Next, what if we combine short and both short position of call and put? Okay, and issue that if we combine this and this, then suppose X1 is greater than X2, then we have right, something like this, X2, X1, right? If you sell both of them, and if you now, so it is okay, it is pure payoff of having short position of the call and put. But suppose you or perhaps some cash, which is maybe because of premium of the selling those two, then what your in the end your position would look like this. So this is plus maybe some cash. Okay. So it is profit. Okay, it is a pay up and pay up. So I mean, if you sell call and put option, you receive some money, right? And then the distance is what you have received by selling and put and call. So basically, this is called short strangle. Long strangle is looks like this. Long strangle is having the position, long position of both put and call. So in short triangle, this strategy offers limited profit but with unlimited downside. So let's investigate. Okay, let's look at this example again. This is actually this one should be. Okay. So but anyway, the maximum profit we can obtain this triangle is this amount, right? This is the maximum profit we can obtain. And then how about loss? Loss is unlimited. So if you have short position, you have again limited profit, okay, but unlimited loss. A trader would believe short strangle useful if she expects little volatility in the underlying asset near term. So you can guess who wants to have this short position, short strangle position. You would want to have this position if stock price is somewhere between these two, right? Which means that you believe stock price don't move too much, okay? Don't get volatile much. So if it is in the narrow band, you make money. And when stock price goes either very up or very down, you will lose money. So short strangle is basically it is your betting, okay? Betting against volatility. It is your betting that market will be stable in future. Does it make sense? Short strangle position. This is called short strangle position. Okay. Short strangle is combination of short position in put and call. So it is again short position. If you sell both call and put together, and both they have different exercise price. So it is a short strangle, called a short strangle. Long strangle is opposite. It is called a short strangle because it is a combination of two short positions, put and call. And again, this short position is your betting against the volatility. If you believe market is not extreme in the future, okay, market there is no like crazy event in the future. If you believe that, you wanna invest that kind of product. Yeah. 할 수 있으면 그렇게 해야지. 할 수 있으면. 그렇죠. 재빨리. 예. 그래서 스탁 프라이스가 많이 움직일 것 같아 중간에. 그럼 재빨리 이 포지션을 바꾸든지 처분하든지 해야죠. 그러고 싶겠지 사람들이. 많은 사람들이. 하지만 여기서 같이 10분 동안 갑자기 3%가 하락해 보이면 10분 동안 성질 수가 없는 경우도 생깁니다. So let's continue. This type of strangle strategy has been very popular among institutions in 여의도. Figure 2 describes the short position of actual wise asset management conducted. Conducted, not conducted. Of, okay. Okay. This is wise asset management. So what they did is that they sold put option of the 180,000 contract with exercise price of 252.5. Okay, And they also sell, okay? They sell call option by 70,000 contracts, exercise price 257.5. And contract size is they deliver to 100,000 of index. Okay? So therefore, this is the exercise price of the put option part. This is the exercise price of the call option part. Okay? Therefore, at that time, okay, yes. So their maximum possible profit was $1.8 billion. And if they this YGSMA must have made money if the stock price is somewhere here, actually. So right before the event, okay. Where is the previous graph? Okay, stock price was between 254 and 5, right? Stock price is highest point was 256.1, so 44, 45. And stock price was somewhere here, okay? So YGSM management was very happy at that time because they were somewhere here, okay? They was about to make $1 billion, and so in 10 minutes, stock price becomes this point. 문은 닫고 가야 될 거 아니야. Okay. Now, okay. Now, since stock price is 2.7547.51, wow. So therefore, their loss is $88.8 billion. Okay. It becomes their loss. Okay. So you understand what is going on? Okay. This is simple, right? There's no difficulty, nothing serious about this. Yes. Maybe the price is different. I mean, no, not price different, but I don't know. It is their particular strategy, and if they have a different amount of contracts, then maybe it changes the slope each side. Okay, and it doesn't matter. But anyway, yeah, maybe the price was different, so maybe they have a different price and something like this, so maybe they want to have a balance. So this is the position of YSM management. So this is what happened. So suddenly from here, stock price goes to here. So heaven and hell suddenly. Figure 2 describes the short triangle of YSM management. The firm called this product as a dark horse fund. Okay? They call this one as dark horse fund. This dark horse fund had a very simple structure, as I explained. It sold 180 contracts of the put option at the exercise price of the 252.5. And they also sold 70,000 contracts of the call option exercise price of 257.5. Each contract denotes 100 units of KOSPI 200 index. Therefore, as far as KOSPI 200 remained stable between 252.5 and 257.5, the fund could have made 1.8 billion Korean won. However, its loss could explode if KOSPI 200 moved far beyond the range. And then, unfortunately for large assets, this is exactly what happened during the option shock. On September 11, not September 11, 11/11/2010, the KOSPI 200 dropped from 254.86 opening price to 247.51 closing price, and therefore the fund lost 89 billion Korean won. And the fund broke the law by betting more than illegally allowed, as I said. Korean regulators computed the risk of adjusted values of the option contract as the number of contracts KOSPI 200 index plus 100,000. Therefore, the fund could invest only 62 billion Korean won, 5 times of its asset value. But instead of instead it instead it invested 4.5 trillion Korean won, which is around 73 times. We'll take a photo. So this trade by YG Asset Management resulted in large ramifications. Several local securities houses, notably Hana-Daetu Securities, suffered a huge loss as the dark horse fund was unable to pay back the payoff of the short strangle. YG Asset Management and its top managers fell under the scrutiny from both market and regulatory agencies. On the other hand, international investors who purchased the contract won windfall. Okay, not purchases. Let's change it. Who long the thread one windfall as KOSPI 200 promised. Okay? Because they made this loss, so someone must have made this amount of money, which is international investors. Okay? Hit the jackpot. Okay? Some of them were presumed to hit the jackpot. Anyway, after the joint investigation, Korean Regulators and Exchange, Financial Service Commission (FSC), 금융감독위원회, okay, and Final Supervisory Services, 금융감독원, 금감원, 금융위, 금감원, and Korea Exchange, 증권거래소, argued that Deutsche Bank violated the provision on market manipulated by exploring the relationship between spot and future market using KOSPI 200 stocks and derivative trading. FSC's press release described their investigation result. Appendix 1 summarizes the argument of the FSC. If you are interested, you can read it. Anyway, the Korean regulators also notified suspect and misconduct to the Security and Futures Commission of Hong Kong (SFC) and Hong Kong Monetary Authority and U.S. Securities and Exchange Commission and Federal Financial Supervisory Authority of the German (BaFin). In particular, the FSC asked the BaFin to help identify the owner of the account in question and any illegal activities in the trading. Okay. Such requests were made through a formal channel of International Organization of Securities Commission (IOSCO). Further penalties on Deutsche Securities Korea would follow. KRX will not take any action on profit Deutsche made. Prosecutor may deal with it, however. Both spokesman Won Yong-jun told Reuters. Anyway, in a statement of the February 25, 2010, Deutsche Securities Korea said in a statement, Deutsche Securities Korea deeply regret the KRX action, however, respect its decision to impose such penalty. Okay? Let's go to the more numerical investigation of this example. Okay. First, we can do value at risk analysis we learned, and we can do value at risk analysis and stress testing. Okay, suppose, okay, assume that you are a risk manager in YG Asset Management and monitor the strangle position illustrated in the text, like figure 2. Okay, now let's assume that you are risk manager in YG Asset Management, something like this, and you know you have this position. And then suppose you are at the date of November 10th of November, one day before the option shop. Okay, conduct the following 3 analyses using the data about KOSPI 200 from 10-year data. Okay. 2011 to 2010 11-10. Students can download the data on one of the following links. So you can go to directly to KRX, or actually I we have the data. Something like this. Okay, is it data? Kospi 200 data from year 2010 to 10-year data, 10-year daily data. From 2011, 13 to 2010. Okay, so it is data entry is Kospi 200 index. Like that. And then first, we wanna do 1 day and 10 days. Suppose we are interested in 1 day and 10 day value risk of 95% and 99% analysis using the Monte Carlo simulation method. And second, we want to conduct 1 day and 10 day value risk analysis using a historical simulation analysis. And third, we want to conduct stress test. Okay. First, since we learned historical simulation analysis, so let's do this one first, second, because we just learned what is the historical simulation approach. And let's go to the PPT slide and let's read the definition of value risk. Value risk is the loss level such that we are X% confident. Here in our problem, it is either 95% or 99%. It will not exceed N business day, and we invest for 1 day and 10 days. Okay. Day and 10 days. Okay. And then in order to do the analysis, actually, okay, so this is the question 1. 잠깐만. 이거 똑같은 건가? 똑같은 거구나. Okay. So actually, I developed the R code. Okay, conduct 1 day and actually, instructive and answers. Okay, let's do the second first. So conduct 1 day and 10 day value risk analysis using the historical simulation analysis. So let us conduct the historical simulation analysis with 10-year data. 10-year data is again in the Excel file. In the following sequence, this is what we do. First, multiply daily returns realizing for the last 10 years to the Kospi 200 value at November 10. This generates simulated index value, okay, and November 11 based on historically realized return for the past 10 years. Okay. Now let's think about what is the actual return. So here, let me save. So in this case, return is between this ratio between this and this, right? So day of 1 day before, okay, 1 day before the option shop, the daily return was like a 12%, right? It is 12%. So from November 9 to November 10, so during the 1 day, stock price of not 12%, it is too large, 1.2%, okay? Okay, it was 1.2%. Okay, if you are not interested, I think the better one is maybe let's slightly change it and let's use log. Okay. Okay. If we use continuous return, it is like 12%, 1.2%. Let's change it to percent, and then I want to increase number of decimals. Okay. 1.21%. So I generate this. So in this day, yesterday, stock price went up 1.2%. 1 day, a day before yesterday, stock price went up 13%, something like that. So it is the history of daily return. History of daily return for the last 10 years. Okay, I have to delete this one. Okay, so what we are doing is that we can regard each of these as a possible simulation. Okay, in the past 10 years, daily return was something like this. Something like this. So what we can think about is anything that happened last 10 years may happen again tomorrow, right? So it is all daily return. So it is reasonable, right? We can think that if something happened the last 10 years, it can repeat. Something similar can happen again tomorrow, right? So in this case, okay, simulated, we can generate a simulated, okay, cost P, okay, which is, okay, simulated cost P is that since cost P price is something like that, okay, so if yesterday's scenario happened again, okay, then what will be the price of cost P 200 yes tomorrow, which is should be this one multiplied by, now since we took low, so exponential of this one, right? So let me reduce. Okay. So what happened yesterday happened again tomorrow. Tomorrow's stock price should be 258.227, right? It should be. And if what happened one day before, the day before yesterday happened again tomorrow, then stock price would be, okay, now it is, since today's closing price is 255, it can happen again, so with exponential of this one, right? Okay, this is the second scenario. Since today's closing price was 255, and given today's closing price, if first scenario happens, our stock price would be 258. If second scenario happens, we can simply multiply this and this, okay, this and this, and then stock price cost P value should be 255, okay? Let me highlight this special value. Okay, so this is our standard. Okay, so again, it is a historical returns, and each historical return is a possibility. This historical return can happen to today's closing price, right? So in that sense, if you can keep do this analysis, so for example, this one, right? Okay, this is basically this one multiplied by exponential of this one, which is like what would happen if scenario of November 3rd, okay, November 3rd, 2010 happen again tomorrow, right? Then if this scenario happens to this closing price, then tomorrow's stock price should be 255, right? And this is all positive. Well, how about this negative? Okay. October 27th, year 2010, stock price went down 1.72% from yesterday. And if that drops again tomorrow, our stock price should be this one multiplied by this one, which is 253, right? Any question? Yes? 그지 하루하루인 거지. 그래서 10년치를 다 한 거지 지금. 네. 이거 곱하기 쭉 이것만 하면 되니까 어렵지 않죠? 네, 그래서 지금 이렇게 10년 동안의 결과에서 이게 하나하나 시뮬레이션을 다 한 거잖아요 지금. This is all simulated value of tomorrow's cost P based on past 10 years scenarios. 아니, not yet. Okay, wait. Okay, so it is all possible values of cost P200 tomorrow, right? And for each possible value of cost P200, what we can do is we can calculate our profit in the short triangle position, right? So actually I made the R code. Okay, I think we can go to the R code. Where is R code? Question 2. Okay, R code. R code to solve this problem is available here. Okay. And then spreadsheet analysis is available here. I think this is maybe better. I think. Okay, here it is. Okay. 아 뭐야 이게 클릭이 안 되고. 오케이, 그래서 이걸 지금 다운로드 받아서. Okay, so again, this is the data. Okay, this is exactly same data. It is current index, and this is log of this one. Okay, I just calculated. It is return. I just calculated, and it is a simulated values. Okay, and this 1, 2, 3, 4 is the same to my previous one. Where is it? Yeah. It's same to 1, 2, 3, 4. Same. Why it is slightly different? Okay. It should be same. 208, 227. Okay, right? Okay, this is very important. This is our historical data. Here are the daily past 10 years daily return, and each of them is a possible scenario. And we apply each of these possible scenario to this one. And we get the possible cost P200 values over here. Okay? Yes, they are linked like this. For example, something like this. This one multiply this one. So for each possible value of cost P200, now what we can do? We can calculate our profit from the triangle. Okay? Let's go to the figure. Okay? We know this figure. So each possible value of this one, we can know whether we can make profit or loss, right? So historical analysis is basically, this is the formula, okay? So this looks complicated, but it is actually not complicated because it is simply the functional form of this one. So first, 1.8 billion is something like this. So 1.8 billion minus, okay, minus we have first put option position, right? Put option is max of this one. Put option's exercise price was 252.5 minus D4. D4 is simulated cost P200 and 0. Okay, this is the put option position, and contract value of the put option is 1 to 100,000, right? As I explained, number of contract is 100,000, and what? How many contract to have? Contract unit is 100,000, and how many contract do they have in our article? It says that they have contract of 180,000, right? So this is the amount of the short position in put option, okay? And next is the amount of the call option. Short position in call option, okay? Again, let's review our call option. Call option is, okay, sell call option by 70,000 contracts, and exercise price is 2.5, 7.5, and contract size is 100,000 of index. Therefore, okay, this is underlying asset price, which is D4. It is our simulation value. And this is the exercise price of the call option, 2.5, 7.5, and 0. This is call option 5. And contract size is 100,000, so we multiply 100,000. And dark horse fund has 70,000 contracts, so we multiply 70,000 contracts. So this is simply functional position. So it is the shape of the graph. Right? Yes? 그건 그러니까 거래할 때, 저는 옵션 하나 거래할 때 최소한, 그러니까 거의 계약당 그렇게 거래를 한다는 거지. 그 룰이에요. 네. 그래서 한 계약하면 거기에서 인덱스, 한 계약이 뭐냐면 인덱스 곱하기 10만 하면 거래가 된대요. 그냥 규칙이에요, 규칙. 이거 자체가 한 계약 사이즈가 여기서부터 여기까지 is one contract size from here to here. Okay? So I mean, not anyone can trade in the option market. They should have a certain amount of quantity. That minimum amount of quantity is in some sense 100,000 contracts. 100,000 unit of the index. Okay? Okay? So since we know, so basically, so simply speaking, this is the shape of this graph. So what you want to know is whenever we have simulated volume, we find the profit and loss. Okay? Therefore, since this is the daily return, and this is simulated cost P, okay? And then this is simulated profit upon our historical analysis. Okay? Then from this, we could generate this number of, these possible. So in this case, if this scenario happens, dark horse fund lose this amount of money. If this scenario happens, then it is between the band, so they make 1.8 billion. So for each case, we can calculate their profit or loss for each possible scenario based on past 10 years daily return. Okay. Any question until now? 아주 간단하지. 오케이. 아주 간단하죠. 네. 이거 간단해요. 오케이. 그럼 what now we can do is historical analysis 여기 있네. 이걸 좀 숨기고 일단 GH 이건 중학생도 할 수 있는 거예요, 사실. 숨기기. 오케이. historical analysis. 오케이. So what we in the end have is all possible profit losses based on our scenario. Okay. Now what we can do is we can sort this one from the largest to the minimum, right? Largest is of course 1.8 billion. The profit cannot exceed 1.8 billion, right? So once we sort this one, then maybe we can pick the lowest 1%. And then we can find the border value, right? Remember, in our definition of value at risk, what loss level is such that we are 99% confident that it will not exceed the N business. So it is 1 day. We are first in this 1 day. Then in 1 day, what is the 99% value of the constant? So we can sort this one from top to bottom, and top to bottom we can 99%, and then bottom is 1%, and we will find the border value, and the border value is 1% is this one. In Excel we have a convenience function called percentile. This percentile function is first we set the range is from this entire value, and M2 is 1%. Okay, so we are interested in 99% confidence. So which means we are looking for last 1 point value, border value, and which is called percentile. So in this range, I want to find the value at the exact 1%, which is how much is that? Million, billion, okay? 159 billion, 580 million, 843,793, okay? And 5% is also easy, right? Again, we can apply exactly percentile function, and in this range, I want to find, so it is a sorted value. I don't even have to sort it. So I am looking for this value, such that this is 5%. Okay, I'm looking for this value, and this is the around $81 billion. Okay, so what I can say is that I am here. I am 19. If we believe this historical simulation, I am 99. I am 99% confident that my loss will not exceed this value in one day, right? And in this case, I am 95% confident that my loss will not exceed this value from here, from today to next day, in one day. Okay, it makes sense, right? How about 10 days? The rule of thumb is that here we can simply multiply square root 10. Okay, so it means that I am 99% sure that my loss will not exceed this value and risk value. This is called value and risk for the next 10 days. I am 95% certain that my loss will not exceed this value next 10 days. Okay, so it's very easy, right? Yeah. So we can make a conclusion. Okay. Conclusion that historical analysis. Okay. Again, let's summarize what we have done. Multiply daily return realized for the last 10 years to COSPI 200 value at November 10th, okay, today. This generates simulated index values at November 11th based on historically realized return for the last 10 years. Second, we evaluate strangle position at each simulated index value. So we find 1% and 5 quantile values, which is percentile value in that, to find the 99% and 95% one-day value at risk, and compute 10-day value at risk by multiplying 10-day by multiplying 10. Okay, and this is simple, right? So in the end, okay, the answers are one-day VAR is, as I said, one-day bar. Okay, one-day VAR value is one-day bar is like 200 billion, 99%. Okay, then 116 billion for 95% bar. Okay, you can simply square root 10 times one-day bar to take the 10-day bar. So anyway, thus minimum capital requirement for the wise asset management is, okay, 1.80. The value is, which is, okay, I think this is over here. So regulators usually require a bank capital for the market risk to be at least 3 times of the 10-day 99 value risk. Okay, so usually what regulator requires is 3 times of 10-day 99% value risk. So therefore, it is this one. So what regulators requires that we should have at least 3 times of this one. This is what bank requires. Okay, and then what regulators requires. This is slightly, we have a slightly different value, but anyway, I think it's anyway, yeah, we should go here. So yeah, 1.8. Why it is different? Strange. Anyways, 3 times of the, I think the number is wrong. So what we require is that 3 times of this one, and then let's see, it is 3 times of, I think this is right, 125. 1495. 이상한데? 약간 에러가 있네. 네, 이 숫자를 제가 다시 한번 체크하겠습니다. 어쨌든, 네. 어쨌든, anyway, let's repeat again. Regulators usually require bank capital market to be at least 3 times of 10-day 99% VAR. So if wise asset management abide by the rule, they have at least should have this amount. This one multiplied by 3, okay, which is 1.5 billion. Actually, not 1.5. 1 trillion, 1 trillion 1.5 trillion, okay, USD, which is 1.5 trillion. 1.5 trillion is actually much larger than a firm's loss was 88 billion, right? He said that the value was this 8 billion, right? And then 88 billion, and which is actually much larger than that value, okay? Okay, 88 billion. Oh, okay. Sorry. It is in Korean, yeah, okay. 88 billion Korean won. 88 billion Korean won. So, 88 billion Korean won. Let's go to the problem. YG Asset Management lost around 88 billion, which is I think I have error. I have error. Okay. Why this one has so many errors? Okay. 88 billion. Anyway, if they abide by the rule that they should have 3 times of 10-day 1%, 99% bar, which is around this value. If they have this one in the capital, their loss was 88 billion. This is much greater than this one, right? So if they abide by the rule, this 88 billion must be nothing. Okay. Since they have this amount of money, they can pay out this one. Okay. So therefore, if they had this money, abide by the rule, they would have no difficulties in honoring the contract. Right? This could have prevent the disaster in the market. Okay, so this is until now what we showed is like a historical simulation or analysis. So any question? Okay. So it is like similar to what we want was we are suppose is like a possible value of the histogram. Okay, suppose it is a histogram of the profit. Okay, and what we are looking for was this one. So this was 1%, and this is called value at risk. Okay, so this is what we investigated, right? And we actually simulated this. Return structure is slightly different, but we simulate these possible cost P100 values using possible historical returns. Okay? So that is the one strategy. And second strategy is actually called Monte Carlo simulation. Okay? Let's go to our Excel file again. In our Excel file, okay, what we did is that we multiply from the yesterday's post-peak closing price. We multiplied basically historical daily returns, right? That was our strategy, and we simulated cost-peak values. Now, actually, there are alternative strategy. This is a strategy of simulating cost value based on historical return. Another strategy is actually if we know mean and standard deviation of this one, okay, and if we know this follows some sort of normal distribution, for example, then we can directly simulate those values, right? So let me show that strategy again. So let me unhide, okay, unhide, okay. So so standard deviation, okay. How can I see this one and this one together? Okay. First, we can calculate the standard deviation of our historical data. So standard deviation is 활표 어디서 찾지 이게? 활표 참조되는 셀수. Okay. So first we can get the standard deviation all the past return. Okay. Second, we can calculate the average. Okay. We can calculate the average of the. Okay. We can also calculate average of the past 10-year daily return. Okay. Okay. And then this is of course minimum of that one, so not important. So suppose, okay, suppose we can assume that this all past returns follow normal distribution, okay, normal distribution with mean is normal distribution, then is mean is this one, is standard deviation is this one. We can calculate this one, right, from historical data. And if it follows normal distribution, now we can simulate new returns, right, based on this and this, right? So what I do is I simulate returns. Okay. What I can do is now okay. First I calculate mean and average and standard deviation, and then what I can do is now I can do mean plus standard deviation and some epsilon is from n 0 1, okay, right? Then for each simulation, okay, I can calculate possible daily returns, right? So I can calculate this one and this one with historical data, and I can simulate this one, okay. 왜 갑자기 지워졌지? simulate this one. So in Excel, actually we have very convenient function. Okay, so we have called function called norm inverse, and then you can simply I can explain this one later. But if we do this one, if we use this Excel function, it generates standard normal distribution. Standard distribution with mean of this one and variance of this one. So basically what I did is I'm doing this one. Okay. So given the mean and standard deviation, now I can simulate a random number, which is, so this is all possible returns again, which is generated from normal distribution with mean of this one, standard deviation this one. Okay. So how many simulation I did? I did simulation of I did a simulation 3,000 times. Okay. Obviously, in the previous 10 years data, my data size was what? It is like here like 2,500, right? But now that was the length of the historical data. But now I can simulate, so which means that I can simulate as much as I want. So this is one advantage. So now I can simulate 3,000, but I can simulate 3 billion simulations, right? So one advantage of a simulation is I can simulate more numbers. So again, next procedure is same. For each simulated returns, okay, I multiplied, okay, this 255. Let's click this one. Okay, what I did is yesterday cost me 200, and I multiplied basically this simulated return. It is before multiplied the exponential of this value. Then I have simulated cost p 200. But it is same simulation, but not based on historical simulation. Okay? It is a from standard normal distribution with mean and variance there. Okay? Okay, this one. And the thing is, everything is same. For each possible cosp 200 simulated values, I can calculate profit and loss of the strangle position. Again, this is same. This is same. And so I simulated this one, and then based on this, I can calculate my 1%, 5% value, critical values, which is the percentile of the K2, okay, and then this entire data set, okay, entire data set. So from this analysis, I can calculate 1 day 99% value at risk, and we multiply root 10. Okay, what I can get is 10-day 99% value at risk. Here I find, okay, I find 5% critical value, which is the in 1 day, so which is 1 day 95% value at risk, and I multiply square root of 10, so it is 10 day 95% value at risk. So I could get this one. Okay. And then since we have 10-day value at risk, so I can simply multiply by 3. I think it's 9 that time. Okay. It's 3. Okay. And then the value is the, so yeah, this is the answer. Yes, so it's 1.57.6 billion, 1.08 billion, and 5%. And then simply, and I get the value at risk. So regulators usually require bank capital for market risk to be at least 3 times of 10-day 99% value at risk. So it should be this one multiplied by root 10 multiplied by 3. That's something they should have, which is $1,495 billion, which is again greater than their loss. Okay. Greater than their loss of 88 billion. Okay. Therefore, if they abide by the rule and hold the minimum capital of this one in their balance sheet, they could have prevented the disaster well. Okay. Again, the procedure is simulate return from n0. Here I didn't use 0, but I can. It doesn't matter. We can use either 0 or here in this case 1.7. Okay, 1.73%, and this is very close to 0. So it doesn't matter whether you use this value or 0. But here I use 0. And then multiply this simulated return to cost with 200 value at 1 day before the option shock, which is 253.13, and this Google one simulated value of this one. Value the strength at each simulated value, and I iterate it many times. Here I iterate only 3,000 times, only 3,000 times. So whenever I do the simulation, this value changes, right? Whenever I do the simulation, those value changes, right? Because I did only 3,000 times. if I do it like many times, these values are very stable. Very stable. So then I can calculate 1 day, 10 day value risk, and 99% and 95% using percentile function of the exam. Any question? And then there is also something called the stress test. Stress testing estimated how a firm's portfolio would have performed under the most extreme moves in the past 10 to 20 years. Okay? So in the stress test, we are assuming the worst case scenario. Okay? Of course, the worst case scenario is minimum return over the last 10 days, right? Here, right? Here the minimum, okay? Here the minimum value is I can calculate minimum, okay? I can calculate minimum for the possible 10-day daily return, and then we have minimum function. Minimum value is minus 12%. So which means that for the last 10 days, an event of 12% drop had actually occurred. Okay, and our stress test is what if that worst case scenario happens again. Okay, so it is very easy. Okay, in our 10-year data, the most extreme moves were first minus 12% and plus 11%. Okay, to apply minus 12%, the loss would be 521 billion, which is again far larger than realized loss of 88 billion Korean won. 88 billion Korean won. So, which means that if the dark horse fund conducted this value risk analysis and calculate minimum capital requirement or like a stress test, and if they did cautious and prudent risk management, they must have avoided this disaster. Any question? Do you have any question? 질문 있어요, 질문? 어렵지 않죠? 네? 굉장히 인투이티브하지? 그러니까 밸류 리스크가 뭐냐면 여러분은 배워도 신뢰도 구하는 거하고 똑같은 거잖아. 그렇죠? 신뢰 구간에서 95%면 1.96이고 99%는 2.3인가 뭐 막 그런 거 있잖아. 그거 찾는 거랑 사실은 똑같은 거지. 여러분 고등학교 때 이런 거 비슷한 문제도 풀어봤을 거야. 질문 없나요? 이걸 가지고 R로 한번 다시 복습을 해보겠습니다. 잠시 후에 R로 만들어봤으니까. Homework due next week is develop R code about this option shop. Okay. Actually, this is your answer. Okay. But I just figured out you cannot access this one. Right? So you have to somehow memorize this one. Now. Okay. So anyway, I'll go. Don't worry, I'll show you line by line about homework. So homework. First one is delete all memory. Okay. Second, first I define the profit function of our short straddle position. So it is a unit is unit is a billion Korean won, right? Billion Korean won because it is billion Korean won because okay. In the option shop, let me go to the figure again. Okay. Figure again. So contract size is 1, 2, 3, 4, 5. We have so it is 100,000 and we have 1, 2, 3, 4, 5. So we have this number of units. So if we use billion unit, okay, billion units, we can simply it is much easier. We can it is 18 and 7, right? So that's why I use billion unit. So if we use unit as a billion Korean won as a unit, a profit function is something like this. So in the straddle position, maximum is 1.8, and then this part is put option position, and this part call option position. So what I did, I defined a profit function of the short straddle position. So in this function, if I put, so it is profit x, looks like profit x. So if we put some value on x, and it calculates this value and generate this output. Okay. So this one. First, of course, I have to upload the data. So I call it as a data to try to read CSV, something like this. In my working directory, I have a TMP and option. This is my working directory, and I saved the file called cosp. So let me open this file, and this is my file. Looks like this one. Okay, so this is my data set. So I read this data. And so let me run from here to here. Okay. Where is R? R. Okay, so I run my function, my own defined function, and I uploaded data. Data read CSV, pass, CI wrote, I read, CSV file, and header is true, right? Header was true, so it is fine. So let me type the data, and it looks like this. So this is correct. And the second column of the my data set is the part I need. Okay, the second part is what I need. Therefore, first I defined return looks like this. So return is the one. I use this function called return. Okay. Here, so return is negative of the difference. So in Excel, no, in R, we have a very convenient function called DIFF. So DIFF is like lag. So okay, I use log of the second column of the data, right? So this is my data, and I take log, and if I take diff, then it calculates difference between previous one and t minus 1 and t. But I need a difference between, what I need is log, okay? Log st minus log st minus 1, right? This is what I need, right? What I need, but if I use only DIFF, it calculates the other way, because I sorted the data such that earliest one is at the bottom and least one is at the top in our data, right? Usually when people do the analysis, it is by order of the time, but in our data set, it is the inverse of the order of the time, right? That's why I have to put minus in front of DIFF. So, okay, in that way, I calculate returns. And then third, I can make standard deviation and mean, okay? I can calculate standard deviation and mean. Okay, so 메시지가 손실되었습니다. Anyway, it is fine. Okay, so S is this one, so mu is this one. Okay, so actually S is not necessary. I calculate mean and variance. So mean is, as I said, is 0.017, and mu is something like this. Strange. Mean, standard deviation. This is VAR. I think so VAR. Okay. So okay. Anyway, although I have error message, the value is apparently right. So anyway, I calculated mean and standard deviation to do the simulation. Okay. So next, okay, next I want to do simulation like this. Okay. This part is like this. Okay. What I did is number of simulation is 10,000. So in previous Excel file, I did the simulation only 3,000 times, right? But here I did simulation of 10,000 times. Okay, even 10,000 times is actually not enough. Okay, not enough. But anyway, let's do the simulation 10,000 times, and let's define P0 is first element of the second column data 1, 2. So which is the most recent data point. It is the stock price, Kospi 200 price at November 10th. Right? So P0 is this one, and next R1 is my simulated value. Okay, my simulated value. So I simulate 10,000 times with mean 0. Alternatively, instead of 0, of course, I can put mu over here, but it does not matter. But it is because it is so close to 0. And I calculate R norm, random number from normal distribution. How many times? Anything. Okay, 10,000 times with mean 0. Standard deviation is 1.7%. So R1 is my simulated response. Okay, so R1 looks like this. Okay, R1 looks like this. Okay, yeah, R1 looks like this. And second, R2 is square root of this one. So R2 is what? R2 is if I multiplied root 10, okay, root 10, so it is R1 minus root 10, so it is like 10 day. 10 day return, okay. 10 day return. And P2, so P2 is a matrix 0 and M2. What is this? Why I defined this one? So it is for convenience, I think there are smarter way. I know how to do that, but I think it's for educational purpose. It is right. First, I set a dummy matrix such that P2 is filled with 0. It is a matrix filled with 0, and it has a 2 column. Length of the row, number of row is 10,000, and it has a 2 column. And then in this, I fill each P2 with the profit. So basically I'm simulating the profit. So for each, so my P2 is looks like this. Original is 0, 0, 0, 0, looks like this. And I fill this one with 1 day profit and using 10 day profit. Okay. So what I did is, if I multiply P0 and exponential of the R1, then it is my cos P200 value 1 day later. And if I multiply P0 and exponential of R2, which is square root 10, then it is returned for 2 days, 10 days later, right? Also, this P0 exp R1 is simulated cos P200 tomorrow. It is a simulated cos P200 10 days later. And for each simulated value, I apply profit, and I fill P2 matrix with profit. Okay, profit from the triangle position. Okay. So this P2 is my simulated value. So next to a simple. First, I use quantile function. Okay. So let's implement this part. Quick, very quick, okay, very quick. So let's say P2 is filled with my simulated profit. Okay? Simulated profit. So in many cases it is 1.8, something like that. So it is my simulated values. Now I understand what's wrong with my Excel. So Excel is some error. So anyway, so what I first calculated using in order to calculate the 1 day value at risk. 1 day value at risk. So I use P21 first column of the P2 matrix, and then I want critical value of 0.01 and 0.05. So therefore it is 1 day value at risk for 99% and 95%. For D2, again I calculate quantile. Quantile. I calculate quantile based on bottom 1% and bottom 5%. Therefore it generates 10-day value at risk for 99% and 95%. And 10-day value at risk, no, I think it is not necessary. So let's calculate this one. So let's do this one. So D2 and D3 is, so basically what I did 3 ways: D1, D2, D3. Actually, so I calculated basically D1 is 1 day value at risk for 99% and 95%. So unit is again billion. And this one is first, there is 2 ways to calculate 10-day value at risk. In D2 is first, I calculate 10-day return first and calculated profit. Third one is I calculate profit from 1 day first and then multiply root 10. So actually this is, I think I prefer this approach. But anyway, value is not that different. D2 is actually larger. What? Yeah, column by. So D1, D2, D3 is this one. D1. This one, so this one is error. So you ignore this one. The C is this one. So please remember this one. So I just calculate D1, D2, D3, and I just want to show everything to you together. And the capital requirement is of third times of either D2 and D3. If we use D3, so capital requirement is 1241 and 745. And if we use D2, then it is a capital requirement 1488 and 1028. 1488. This is what I use in our one 1495. Yes, so this is I think what I use. I use D4. I multiply 3 to the D2, not D3. Okay, so this is what I have. So I mean, in this case, I did the simulation only 10 times. Only what? How many times? 10,000 times. If we do the simulation more, 100,000 times, I think this one has closer value. So let's do this one. More. So it takes some time. But again, let's go D4 looks like this. But if I calculate D2 multiplied by 3, then 1487, which is 14, slightly different, but I think 1487. I think 1488. Interesting. Still, it is slightly different. But anyway, this number should be more similar. I think if I do the more simulation, I think it will have similar value. But anyway, this is the first step. Okay? So it is the simulation, Monte Carlo simulation based approach of calculating value at risk. Okay? First, any question? Okay, no question. Okay? Yeah. What do you mean by? 있죠. 근데 여러분한테는 안 보일 뿐이지. 네. 여러분이 이제 숙제니까 숙제를 그러면 여러분 누구나 다 카피 앤 페이스트해서 낼 거 아니야. 그래서 여러분 직접 해보라고 난 이제 설명을 해주는 거고 힌트를 주는 거고. Okay? So anyway, this is Monte Carlo simulation. Second, let's do historical value and risk approach. Again, first, our H naught is what is H naught is why I have 0 over here. I think it is some sort of stupid, very stupid. But anyway, what I did is first I define H0 matrix. So H0 matrix is simply P0. H0 matrix is P0 multiplied the exponential of past returns. So it is a simulated OCP200 based on past scenarios. Okay. And second, I multiply 0 to the H0 to the scenario. Okay. This is a bit stupid approach, but H1 is filled with 0, exactly same size of the H1, and I will fill each H1 with the profit of the strangle position, and then therefore I'll fill for I in 1, 2 lengths of H1. Okay, I'll fill each i's element in H1 matrix with profit based on this scenario H0. Okay? Okay. So therefore, H1 is my simulated profit. Simulated profit based on triangle position. Okay. Simulated profit based on triangle position. Okay. So therefore, once now next step is very easy. Since I generate this triangle position, next what I can do is I calculate 1 day value risk first. H2 is 1 day value risk. Okay. So quantile, so based on this H1, which is my simulated profit, I want to find the quantile value, which is critical value of 1.5%. So basically, so this is my 1 day 99% value at risk. Of course, I need plus over here. Okay, 105.9 billion Korean won and 80 billion won. Okay, and then next, since I am interested in 10-day value at risk. Okay, now I multiply square root of the 10, so I can get H3. So it is my 10-day 99% value at risk, 10-day 95% value at risk. Okay. Third, now I can calculate capital requirement. Capital requirement is 3 times of 10-day value at risk. Okay. So my H4 capital requirement is basically 1513 billion capital requirement. Okay, that's what I calculated. And then stress testing. Stress testing is, of course, there are in strangle position I lose money if we have very large return or very negative return. So I take into account both cases. So I calculated minimum of the past returns and maximum of past return and changed it by exponential rate growth return and multiply P0, and so therefore I can calculate possible losses at extreme scenarios, extreme positive scenario, minimum scenario, extreme positive scenario. Okay. Okay, so S1 S2 is looks like this. So S1 and S2. Okay, so apparently I lose more money in the extreme negative case. So I stress test in order to pass the stress test, I need 500 billion capital at least. You can ignore this part. Okay, simple, right? So this is what you have to do in your homework. Any question? 아니요, 근데 엑셀에 있는 게 살짝 지금 에러가 포함되어 있을 거예요. 예. 제가 여러분의 이해하기 좋게 이렇게 했는데 아무튼 네, 제가 방금 설명한 대로 하면 됩니다. 네. 엑셀에 있는 거 R로 바꿔도 되고, 예. 뭐 그래도 크게 틀리진 않으니까. 네, 뭐 그런 겁니다. 근데 숫자들이 약간씩 다르겠지. 히스토리컬 바는 똑같겠지만 시뮬레이티드 바는 다르겠지. 시뮬레이션 할 때마다 다르니까 엄청나게 많은 시뮬레이션 하면 똑같겠지만, 예, 한 1000번, 3000번 정도 계속 달라지겠네. 한 100만 번의 스테이블 밸류가 나와요. So this is your homework. Just reproduce what I explained and I'll delete this one. 이 폴더를 영구적으로 삭제하시겠습니까? Yes. 다시 시도. 뭐야 이게? 네. 문창 닫기. 안 지워지네. 그래도 just in case. 이것 때문인가? 이것도 닫고. 저장. 아니요. 됐다. 네. So, 창 닫기, 탭 모두 닫기. 그 다음에 탐색기 열기, C, TMP 비어 있습니다. 휴지통 비우기. 비울 필요도 없네. 이미 영구적으로 삭제해서. Okay, so this is your homework. Any question? And by the way, how are your projects going? Okay, as you know, you have to submit your own project as a term paper for this class. You have to collect your own data and you have to do some sort of econometrics analysis. That is very important. That is like 20% of your grade. So please work very hard about your term paper.